Hi there, this is Anton. Today, we're talking about why the banks have decided to raise their dividend despite the pandemic. If you remember correctly, the Federal Reserve prevented the bank from paying out dividends during the pandemic. And these companies are the main cause of the 2008 financial crisis. The US regulators has set up an annual ritual to test these companies to see if the revenue is completely wiped out. Moreover, they need to approach the Federal Reserve before they can raise their dividends. Hence, in this video, we'll be talking about why the Federal Reserve has allowed the banks to raise their dividends. Before we continue, please smash the like button. And if you'd like to see more such videos, please subscribe to this channel. Firstly, we're talking about briefly about why the US regulators need to implement checks in the banking sector. Given that the banks were the main reason for the 2008 crisis, the US regulators did not want to experience another financial crisis again. So to have control over the banks, the Federal Reserve will carry out assessments every year to make sure that these banks can stay alive, even if their revenues are slashed. Next, we'll be talking about how the Federal Reserve gave US banks a thumbs up as all 23 lenders easily passed the 2021 stress test. The Federal Reserve announced that the biggest US banks could easily withstand a severe recession, a milestone for the once beloved industry. The Fed, in releasing the results of its annual stress test, said all 23 institutions in the 2021 exam remains well above minimum required capital levels during a hypothetical economic downturn. That scenario includes a severe global recession that hits commercial real estate and corporate debt holders and peak at 10.8% unemployment and a 55% drop in the stock market, the central bank said. While the industry will post $474 billion in loss cushioning capital will still be more than double the minimum required levels, the Fed said. If there was an anticlimactic note to this stress test, it is because the industry underwent a real-life version in the past year when the pandemic struck, leading to widespread economic disruption. Thanks to help from the lawmakers and the Fed itself, banks fared extremely well during the crisis, stockpiling capital for expected loan loss that mostly does not materialize. Nevertheless, during the pandemic, banks had to undergo extra round of stress tests and has restrictions imposed on their ability to return capital to shareholders in the form of dividends and buyback. Those will now be lifted as the Fed has previously stated. Following the passage of this latest exam, the industry will regain a measure of autonomy it lost since the last crisis. After playing a key role in 2008 financial crisis, banks were forced to undergo the industry exam and had to ask regulators for permission to boost dividends and repurchase shares. Now, under something called the Stress Capital Buffer Framework, banks will regain flexibility in how they want to dial on dividends and buybacks. The Stress Capital Buffer is a measure of capital each firm needs to carry based on weakness of the operation. The new regime was supposed to start last year, but the pandemic intervened. During a background call with reporters, senior Fed officials pushed back against the idea that the new regime result in a free-for-all. Banks are still subject to restrictions, and the Fed is confident that the Stress Capital Buffer Framework will protect their ability to support the economy during a downturn, they said. Secondly, we will be talking about why investors see value stocks leading the way in the second half. Wall Street investors believe inexpensive and economically sensitive stocks will retake the lead in the market in the second half of this year, according to a new CNBC survey. As part of CNBC quarterly reports, we pull about 100 Chief Investment Officers, Equity Strategists, Portfolio Management, and CNBC contributors who managed money about where they stood on the markets for the rest of 2021. The survey was conducted from June 23 to June 30th. Nearly 70% of respondents said value stocks will do better than their growth counterparts in the next quarter. After an impressive rebound from the pandemic low, the rally in value shares paused. The Federal Reserve hawkish policy pivot and inflationary pressures made investors reassess the outlook for the economic growth. The Russell 1000 value index fell 1.3% in June, trailing its growth counterparts by more than 7 percentage points, as tech stocks outperformed, with bond yields stabilizing. Investors could be betting on a rotation back into value on the belief that the case for economic recovery remains intact and should result in rising yields again in the coming months. Nearly half of the survey respondents said the 10-year Treasury yield will top 2% by the end of the year. Major banks are boosting their dividends following the Fed Reserve stress test, where all 23 banks past the central bank said the industry is well above required capital in a hypothetical economic downturn. Next, we'll be talking about the banks raising dividends payout. Morgan Stanley, the Wall Street powerhouse, doubled its quarterly dividends and announced a new $12 billion stock repurchasing plan. The bank said in a press release that its dividends will jump to 70 cents a share starting in the third quarter, and it will buy up to $12 billion of its stock through June 2022. Shares of Morgan Stanley popped almost 4% in after hours. Quote, Morgan Stanley has accumulated significant excess capital over the past several years and now has one of the largest capital buffer in the industry, CEO James Gorman said in a release. The actions taken by the board reflects a decision to reset our capital base consistent with the need we have for our transformed business model. Morgan Stanley's new capital plan appears to be among the most aggressive of the banks rushing to announce at the market close. Larger rival JP Morgan boosted its dividends by 11% to $1 per share, according to the bank. JP Morgan said it continues to be authorized to tap an existing share repurchase plan. Bank of America says its dividend will rise 70% to 21 cents. In April, the bank announced a $25 billion share repurchase plan. Goldman Sachs says it plans on boosting its dividends by 60% to $2, subject to approval from the bank's board. Wells Fargo also said it plans on doubling its dividend to 20 cents a share. It also announced an additional $18 billion stock repurchasing plan beginning in the third quarter. The firm's dividends increase was widely expected by analysts because it was one of the only banks forced to slash its payout after last year's stress test. Now banks reclaim flexibility in how they choose to draw on capital in the form of dividends and buybacks. As long as they maintain capital level above something called the stress capital buffer, banks can make more of their own decisions. The new regime was supposed to start last year, but the pandemic intervened. Finally, we'll be talking about the earnings call of these bank companies. One of the companies that we'll be talking about is Wells Fargo. Wells Fargo reported second quarter's earnings and revenue results that topped Wall Street's estimates as it continued to release funds it had set aside during the pandemic to safeguard against widespread loan loss. Wells Fargo result was boosted by a $1.6 billion release of its credit loss reserve as consumers performed better than the bank anticipated amidst the pandemic recession. Financial firms started to release their reserve as the recovery has accelerated in 2021, boosting profits as a result. Wells also reported a net interest margin, a measure of how much a bank earns from the difference between what it pays on deposit and what it takes on loan, of 2.02%. Analysts were expecting 2.05%, according to FactSet. Persistent low interest rates have continued to weigh on that part of the bank business. The bank reported an efficiency ratio of 66% compared with the estimate of 76.1%, indicating that its operating expenses as a proportion to its revenue have improved from 80% in the June quarter of 2020. The financial update from a San Francisco-based lender came nearly 1 week after CNBC reported that it is shutting down all existing personal line of credit in the coming weeks and stop offering the product. Wells Fargo credit line has let customers borrow $3,000 to $100,000. The bank built the line as a means to consolidate higher interest credit card debt, pay for home renovation, or avoid overdraft fees on linked checking account. The next company that we're talking about is Citigroup. Citigroup posts second quarter results that benefit from a $1.1 billion boost from released reserves set aside for loan loss. While the bank managed to top expectations for revenue, the figure declined 12% from a year earlier, driven by lower results in fixed income trading, falling credit card loans, and dropping interest rates. Jane Fenster, who officially became CEO in February, announced in April the Citigroup was assisting retail operations in 13 countries outside the US to improve returns. Like the rest of the industry, Citigroup is expected to release some of the monies it has previously set aside for anticipated defaults tied to the pandemic. The firm may also benefit from strong Wall Street advisory activities in the quarter. The third company that we'll be talking about is the Bank of America. Bank of America shares dropped after banking giant post second quarter results well below analyst expectations. The company said revenue fell 4% from a year earlier, driven by a 6% drop in net interest income because of lower interest rates, lower trading revenue, and the absence of a $704 million gain earlier also hits revenue, the bank said. Bank of America results shows the impact of falling interest rates on the industry. Banks gather deposits and extend loans. Falling interest rates squeeze the margins between what they pay and charge borrowers. The bank posted a net interest margin of 1.61% in the quarter, a drop of 26 basis points from a year earlier and below the 1.67 estimates of analysts. CFO Paul Boniface cited the continuous challenge of low interest rates in the bank's earnings release. The 10-year Treasury yield broke above 1.75% in March amidst the economic comeback, hitting its highest level since the pandemic began. While an industry-wide decline in trading revenue was expected, given the strong quarter a year ago driven by central bank response to the pandemic, Bank of America appeared to have underperformed. The bank's fixed income trading operation generated $1.97 billion in revenue, well below the $2.7 billion estimates of analysts surveyed. That shortfall was partially made up by the equity division, which produced $1.63 billion in revenue, topping the $1.35 billion estimates. Like other lenders, Bank of America set aside billions of dollars for credit loss last year when the industry anticipated a wave of defaults tied to the pandemic. Instead, government stimulus programs appear to have prevented most of the fear loss, and banks have begun to release reserves this year. The bank said that it has a $1.6 billion boost in second quarter as it released reserves amidst an improving US economic outlook. The final company that we'll be talking about is Goldman Sachs. Goldman Sachs reported second quarter earnings that blew past Wall Street expectations, propelled by strong performance in investment banking amidst a robust IPO market. Goldman Investment Banking segment posted its second highest revenue quarter ever, behind the first quarter of 2021, as a booming IPO market boosts its equity underwriting. Companies are rushing to go public this year to take advantage of a stock market at record highs. Capital raised via traditional IPOs in 2021 totaled a record-breaking $135 billion, far surpassing a 5-year average of only $53 billion annually. Goldman's net revenue from investment banks totaled $3.61 billion, ahead of estimates of $3 billion. The backlog increased significantly from the end of 2020, ending the second quarter at a record level, the bank said. Goldman trading business saw an expected slowdown as the boom from pandemic-induced volatility started to fade. Net revenue totaled $4.9 billion in the last quarter compared with $7.58 billion in the first quarter of 2021. The sum was split between $2.3 billion in equities trading and $2.58 billion in fixed income. Both figures came in slightly above estimates. Its asset management unit generated record revenue of $5.13 billion in the second quarter, boosted by record sales from equity investments. Goldman also announced that its board approved a 60% increase in the quarterly dividend to $2 per share beginning in the third quarter. In conclusion, these bank companies could finally reward the shareholders through payouts and buybacks. Given the performance during this pandemic, we could not tell whether this great performance is done by these banks or the support by the Fed. Due to the support of the Fed and the swift cut in interest rates, the US economy has been saved from the pandemic. However, as these banks are the face of implementing the move, investors are extremely supportive of the move made by these banks. But I still feel that investors should not look at these bank companies, but look at the other real banking companies. With that, thank you for a nice day. Goodbye.